Thanks for joining me this Friday, the 12th of September. I'm Grady, Senior Market Analyst with Bell Direct, and this is our weekly market update. We are 2 weeks into September now, and the market has extended its sell-off to start the new month into this trading week, as investors took profits from areas of strength during reporting season and repositioned portfolios to weather renewed global macro uncertainty for at least the start of FY26. Despite being down over 1% so far this September, the ASX hovered around record territory over the last months, and valuations remain stretched for key areas of the market that may face some headwinds on an earnings growth front and cost front in FY26. This week we hosted the first Bell Direct webinar for 2025, Managing Market Volatility, where I sat down with 3 of Bell Potter's leading research analysts to discuss their take on reporting season, macro outlook, rate insights, opportunities, and tactics to navigate the currently elevated volatility level of the global market landscape. This weekly wrap collates the key insights from the webinar to deliver a concise overview of the analysts' answers to guide your investment journey this September 2025. Rob, I thought I'd start with you. We are on the back of FY25 reporting season. What did you see? What were the highlights, lowlights, surprises, outlook for FY26?
I think the key word for reporting season was volatility. And we've seen some volatility in the past few reporting seasons. This one's on a different level.
Yeah.
I think one of the key phrases that we've spoken about is don't miss. If you miss consensus expectations, you got punished, disproportionately punished probably, but you got punished pretty harshly. So, I take Woolworths versus Coles as a good example there. Woolworths down over 10% on a sort of earnings miss, Coles up 10% on an earnings beat. And so really there, you just got this disproportionate sort of reaction to what happens in terms of the earnings, in terms of the share price reaction. So that's one. The other sometimes was we had elevated valuations going into this reporting season, and just actually being in line with consensus wasn't enough. Take CBA as another example. Obviously, a very elevated valuation at the moment. Came in, it hit earnings expectations of consensus. It wasn't enough, and it was down 6% on the day. So you're getting it's very, very volatile at the moment. And it's very, very hard to read sometimes how the market's going to react to what we saw in reporting season. The other thing we saw is that US exposed stocks were punished and they struggled. We certainly saw that in the housing sector or housing exposed, something like James Hardie's, Reece, Reliance Worldwide. They all got, again, punished pretty severely. The market got very worried about their growth outlooks over the next 12 months. After their results all missed, yeah. and their outlook comments were pretty bearish as well. So there's the 3 key themes that I've taken out of that.
Chris, technology sector for the season and the reporting season, what were your highlights, lowlights? And you did make some differences in valuations, and you upgraded, downgraded. Talk to me about what you saw.
Okay, so like Rob said, it was a bit hit and miss. So I had good results like 360. I had less than good results like WiseTech. The sector, though, like Rob said, the valuations are already pretty stretched. So if you missed, you got punished. But as Rob also said, we're in an interest easing rate cycle now. So that's good for tech. That's good for healthcare. Mm-hmm. And so in theory, if you don't miss and you continue to perform, you'll be rewarded. And your earlier comment in a momentum market, mm-hmm. I think you got to be conscious what sort of market you're in. Yeah. And we are in a momentum market. So the trend is your friend, as long as you don't slip up. So 360 might look very expensive, but they continue to produce good result after good result. And if you continue to do that, you should be rewarded. But what John and I do, I think, different to Rob. Rob's more top down, yeah, which is why we got him.
Yeah.
John and I are more bottom up. Yeah. We're looking for the good companies that perhaps aren't as stretched in terms of valuation and trying to find some gems or some diamonds in the rough. And there's some that I'll not talk about now because I know it's coming later, but there are still some opportunities that we can see.
Chris, high growth tech sector, tailwinds coming, interest rate cuts. Where is the biggest growth in the tech sector, in your opinion, where valuations aren't quite stretched out?
Okay, so I think higher growth always tends to be with the smaller companies because obviously the hurdles are lower.
Yeah.
With that said, WiseTech is still growing very strongly, as is 360 and Tech One. But the sweet spot for me, but I think for Bell Potter in general, is we like to find those high growth stocks at the small mid-cap space. And I think I've found two that really stood out for me in the last few months. And it's a bit rare because I haven't found two stocks I think this good for some time. And they both delivered good results in the months just gone. So the two are Adveritas and Canadico.
Healthcare been a bit beaten down since COVID, but the outlook is there for growth in FY26. What did you see in reporting season? Obviously, it's a bit different on a reporting season front for healthcare companies.
Well, the most topical stock was collates CSL.
Yeah.
There was an avalanche of bad news announcements on the results day, and of course the stock got punished.
Yeah.
We'll get into the detail in a little while, but certainly there's some major challenges for that organisation going forward. On the glass half full side of things, the Pro Medicus result was outstanding. To Chris's point, the result was in line. It was a 30% EPS growth, and that's just continues a string of good results over the last 5 or 6 years for that group. So it remains this premium valuation for good reason, in my opinion.
If you missed the webinar, we have attached the link to the full recording in our Bell Direct weekly email sent out every Friday. And today, of course, it's in that email. And the description of this video has the link to the full recording as well to ensure that we can help you on your investment journey this FY26. Locally, from Monday to Thursday, in a turnaround week for the local market, the ASX 200 posted a 0.76% rise as the rate-sensitive sectors in tech and REIT stocks rose 4.65% and almost 3% respectively. The winning stocks on the key index were led by Mesoblast, jumping almost 20%, while Vault Minerals rallied 13.6% and NRW rose almost 13%. And on the losing end, Nine Entertainment Group tanked 34.87%, while Pilbara Minerals and Liontown Resources were hit by that renewed supply fear and supply overhaul in China of the lithium, with each falling 14.7% and 12.78% respectively. On the broader market index, the All Ords gained 0.68% as 4D Medical soared 65.8%. John did discuss that in our webinar, so if you want to know about why it soared 65.8%, please see the webinar link. While Sayona Mining tumbled 26.92% this week. The most traded stocks by Bell Direct clients from Monday to Thursday were 4D Medical, unsurprisingly, BHP and Mineral Resources. Clients also bought into CSL, PLS, Telix Pharmaceuticals and Regal Partners, while taking profits from Pro Medicus, Origin Energy and CBA. And the most traded ETFs by our clients this week were led by Vanguard Australian Shares Index ETF, Global X Physical Gold Structured ETF and Vanguard MSCI Index International Shares ETF. On the economic calendar front next week, we may see investors respond to further key economic data from China, with industrial production and retail sales out on Monday, while in the US, key housing data and the Fed's latest decision on the rate front will be announced later in the week. And that's all we have time for this Friday. We hope you had a wonderful week, have a wonderful weekend, and happy investing.